Price action. Price action is an approach to, as much as you can, predictions and speculation, price predictions and speculation. It's used by retail traders and anyone looking to engage in the market to try and find some order in what seems like chaos, to be honest. This is the structure of a price chart for those of you that have never seen a price chart before. You can see that the price action here points to these what we call bars. You can see we have green bars and we have red bars. Now, price action in itself will help you understand the direction that the market is taking. In the previous section, I touched on direction of the market. You are looking to understand which way the market is going so that you can, as best as possible, look to be following the market. So if the market is going up, what you will see is you'll see a sequence of bars that are gradually moving up on the chart, so therefore you would only look to be taking potential buying opportunities rather than going against the overall trend. In the next section we'll look at cyclicity and the minimum standards that you like to see in order to, on a high probability basis, be able to determine the direction of the market. But you see here we have green and red bars, and we'll talk about the bars themselves in a bit more in depth very shortly. Also on the chart you will see a yellow and a blue line, or any line that's plotted onto the chart for you is what we call a moving average. Down at the bottom, depending on the charting software you're using, in this case it is this is a snapshot of the Smart Chart software. You can see the tabs along the bottom, which are called the chart tabs. Any price chart that you'll be looking at, which shows you the overall price action, will show you the date and the time across the bottom. So this is a unit of measurement, and also a unit of measurement for the price over here on the right hand side. So each bar, or a part of the bar, will determine a price point over on the right hand side. The individual bars themselves, we are teaching you with OHLC bars. OHLC bars stands for, or OHLC stands for open, high, low and close. What this means is you see the left hand tab to the side of the bar corresponds to a price that the bar opened at. During the period of time that the bar shows, it will show you the high that the bar pushed to, so this would then mark the high price. The low that the bar reached during that period of time would show you the low, and then where it closed over here on the right hand side, this gives you the final price. So let's say, for example, that this OHLC bar gave a description of the price action, so the action the price took on a daily price chart. This bar would be worth a period of 24 hours. So that means within a period of 24 hours from the market open, the market opened here at 1.4050. It pushed to a high of 1.4095, down to a low of 1.4000, and closed finally at 1.4075. The fact that the bar is green, it means that the bar closed higher in a positive way, more than where it opened. And if it's a red bar, it describes that the seller's bar, so the sellers managed to push the price down within that 1 day period, or if it's a 4-hourly chart, the bar will determine what happened in a 4-hourly period. If it's an hourly chart, for an hour, and so on and so forth. The price opened here, pushed to a high, pushed down to a low, and closed lower than where it opened. So green if the close is above the open, so the buyers, one in this case, and then in the second case, red if the close is below the open. The price action within the individual bar itself does not mean that the market is going up or down in this case. It just means that the buyers happen to win the battle between the war between the buyer and the sellers, and in this case the sellers won versus the open price. What you are really looking to see, rather than the individual bar itself, is you're looking to see whether the sequence of bars is telling you the story. In terms of time frames and time frames that you can trade on, the price action that you can trade with, these are some examples of the different time frames you can look at. If you're looking at a weekly, a monthly price chart, then the bars themselves will show you what happened in that one particular month. This is what we might look at as an investing time frame to look at, so your positions might take a lot longer. The higher time frames would be for hourly and daily. The 1 hour, 30-minute and 15-minute are examples of what we call day trading, or as traders we like to call that intra-day trading, and scalping would be something you would do on a 1-minute or a 5-minute chart. But as a new trader, something like scalping can entail a lot more risk. So you're much better off looking at higher time frames for the trading strategies to react a little bit slower, so you can make much more calm decisions, and then speed it up on the 1 hour, 30-minute and 15-minute, but you will always be led by your higher time frames on the daily and the 4-hourly. Been like a Forex trader if you've bought currency to go on holiday or to another country. So exchange rates work like this. Whenever you're looking at a broker platform, in most cases, the one on the left, in this case the euro, is showing the base currency versus the US dollar, which is known as the terms currency. So in this case, 1 euro, which is the base currency, will buy you 1.22456 equivalent in US dollars. The one on the left, just to repeat, is always classed as the base currency, and the one on the right is called the terms currency. So as a trader, you are looking to collect what we call pips. You'll hear this mentioned a few times. A pip is a unit of measurement which stands for price in points. They are a unit of measurement in order to establish for you as a trader a level of pips that you can collect over a period of time. So for example, if a trade was worth 100 pips, you would have collected 100 units of measurement, and in this case, if you collected 100 pips, can you guess what the price would be? The price would move up to 13345, as you would have gained 100 pips. If the price went down by 234 pips, then the price in this case would be 10005. If you are dealing with the yen, or any yen pairs, so to speak, so base currency paired with JPY, a pip is still a unit of measurement and it still means a price in point, but we have different decimal points in order to measure that. So if you collected 100 pips on a yen pair, the price would be 101.123. If the price went down by 12 pips, the price would be 100.003. So moving up or down, a pip is a unit of measurement, and you will collect pips moving up or down. So you can either buy or sell a currency pair and make money. In this case, you can see that we're now starting to see a sequence of bars. You can see the market going up and down in this case. But to simplify the matter, assume that you are betting whether the price is moving up or down. As you are not trading the physical currency, you are trading either a spread bet or a CFD. The CFD, or the financial vehicle, allows you to move up or down in a market, so you are not actually physically buying the asset. So those of you that have traded stocks before, I find can find this a difficult point to think of. This is a completely different style of trading. It's a different financial vehicle potentially that you could use, which will allow you to move up and down in the market. So the CFD itself, or the spread bet, is based on the value of the underlying asset as what we call a derivative. So you can see here, moving up or down, you can take advantage of the market. There are 21 currency pairs for you to start trading with. There are more available. However, we would suggest or recommend that these would be, in the current scheme of things, better markets in order to trade with before you get into what we might call exotics and other different currency pairs, or lesser traded currency pairs. These 21 currency pairs will be the recommended currency pairs in order to trade with the strategies. Cyclicity. It's all about the big picture. Whenever you're looking at any market in order to trade it, you really are looking at the overall big picture. I've made reference so far to price action and how those can be put together, how those bars can be put together to create a bigger picture and a sequence of events that happen, so that you can understand the direction the market is possibly taking, so that you can therefore take advantage of it. So there's a funny old saying, it goes like this: trade with the trend, because the trend is your friend until the bend in the end. Cyclicity helps you to work out whether the market is trending and in which direction. When you understand how, it can show you effective entry and exit signals. Therefore, you can trade with the trend and take advantage of the move that's happening within the market. So this is how we look at cyclicity. As traders, there is no certainty, as I like to call it, in the market. The only certainty you can really take in terms of which way is the market going is when you see minimum standards in terms of behavior. So from a cyclicity perspective, if you see the chart moving in an upward direction, we'll deal with downward direction in a minute, what you are looking for is you are looking for price to move away from the trend, but with the trend. That's called a phase one. Phase one is always with the trend, and phase two will always be a retracement, or what we call against the trend, back to bounce and then go off back into another phase one along with the trend, and phase two will be a retracement against the trend. As a trader, you need to see two complete cycles for a trend to be established. So therefore, as a trader, if you're looking at a price chart, you are looking to establish a trend by seeing a minimum of two complete cycles in order to, on a high probability basis, be able to say that in this case you have an uptrend. So if you look at this chart here, we've marked 1, 2, 3, 4 and points 5. So We are going to look at some advanced price action patterns that we can look to see at the end of a phase 2, which would in this case be marked as point 3 and 5, in order to take advantage of the phase 1 as early as possible. So if you have a look here, we've said show where you would like to buy or sell. You can either do nothing, you can either enter a buy, enter a sell, enter an exit, or exit the sell. You would look to enter a buy order at the start of points 1, 3 and 5, and you would look to exit the buy towards, as much as possible, the end of a phase 1. What you would not do is look to enter a sell on points 2 and 4 to sell in a phase 2, because at the moment this is what we would call trading against the trend, and there is a specific way to approach that and do that as safely as possible. So just to clarify, you would look to enter buying orders potentially when you see the market completed a phase 1 and a phase 2 with 2 cycles. And then you would look to enter a buy order at the start of the following phase 1. This is what that might look like. So the red dot would signify a part of the order which we call a stop loss. The blue line would be an entry point, and the green line would show where you would look to come out of the trade. So as a trader, you would look to establish 2 complete cycles of phase 1 and phase 2. So let's imagine that these 2 cycles are cycle 3 and cycle 4. You would look to enter at the start of a phase 1 and then exit towards the end of a phase 1, and always have a stop loss in place so that your account is as risk managed as possible. In a downtrend, you can see here that we now have phase 1 and phase 2 going in the opposite direction. This would be a downtrend. So taking the same way of thinking, you would look for 2 complete cycles of phase 1 and phase 2. Let's imagine these are cycles 3 and 4. And 1, 2, 3, 4 and 5 are the points to discuss. You would look to place a sell order at the start of a phase 1, which would be points 1, 3 and 5 here, to exit towards and take the profit, by that I mean at the end of a phase 1. What you would not do is enter a buy order at points 2 and 4 to take advantage of phase 2. Again, phase 2 trading, there's a very specific way to approach that. You would only look to trade a short trade, so a selling action trade in the phase 1 of the new cycles. Fractals are a way that the computer looks at high and lows in the marketplace. So this takes a slightly different viewpoint of cyclicity. You can see here that the end of the cycle is marked by a black diamond. On the chart, in some of the strategies, you will see that actually a fractal can also be designated by a small grey triangle. You can see there's 2 triangles there, one above and one below. These are different ways of marking the fractal pattern. This would be applicable specifically to a strategy that you will learn called volatility reversal, where fractals will be explained in more detail. Advanced price action. In previous sections, when I'm talking about cyclicity, I referred to price action which you would look to see at the end of a phase 2 before you move into a phase 1. So these could be clear indications when used in a strategy as part of a recipe to take advantage of the price moves, These can help you take advantage of those moves and work out your entry and your exit criteria. In this case, we are going to be talking about a ring high or a ring low formation. So we'll cover ring low formations first. Now, you are not paying attention to the open and the close of the bar as referenced when I talked about OHLC bars. You're still looking at the OHLC bar, but you are only paying attention to the high and to the low. Initially, you are looking at a potential ring low, which consists of bar number 1 and bar number 2. The bars themselves, just to clarify, can be any shape and any color. The color is not relevant, whether it's a red or a green bar doesn't matter. What you are paying attention to is to the high and the low of the bar. So a potential ring low consists of bar number 1 and bar number 2. Bar number 2 needs to have a lower high. So the high of bar number 2 is lower than the high of bar number 1, and a lower low, where the low is also lower than the low of bar number 1. You can see here that you have a blue dotted line and a red dotted line above the high and one below the low of bar number 2. This would signify where you could potentially place an entry and a stop loss as part of an order that you would send to the broker, which is what we call a pending order, before the order triggers and goes live. So bar number 3, therefore, would be the trigger bar. So a triggered ring low formation is when the high of bar number 3 moves through and past the high of bar number 2. In this case, that would trigger the trade, and in this case bar number 3 is being shown here as a higher high than bar number 1. However, bar number 3 is not required to have a higher high than bar number 1. The only requirement is that the high of bar number 3 moves past the high of bar number 2 to trigger the trade. You would look for the potential ring low to be at the end of a phase 2 as depicted here. So 180 profit booster specifically uses ring high and ring low. So the ring low you would look at to be at the end of a phase 2, place an entry above, stop loss below, and then trade into as early as possible within the phase 1. When you attend the program, you will be having a look through these price charts here to pick out ring low potentials, and 7 of those have triggered. The answers are here. You can study them for your own purposes at home. Looking at a ring high formation, so this would be assuming a downtrend. Ring low, as previously, was for an uptrend. Ring high, therefore, is for a downtrend, to look to capture the momentum moving into a phase 1. In a downward market, you would be selling. So bar number 1 and bar number 2 again need to be well, they can be any color. You're not looking at the open and the close, you're just paying attention to the high and the low. So bar number 2, therefore, in this case, needs to have a higher high than bar number 1 and a higher low than bar number 1, with an entry now below the low of bar number 2 and a stop loss above the high. Bar number 3 would have a low that moved lower than the low of bar number 2, but just to reiterate, the low of bar number 3 is not required necessarily to be lower than the low of bar number 2. This is a price action that would be used in a downtrend so that you can take advantage of the downward move. When you're in class, you'll be running through this program here. There are 14 potential ring highs, so 14 sets of bar number 1 and bar number 2. 10 of those have triggered, where bar number 3 has moved lower with a lower low than the low of bar number 2, and these are the answers. So assuming a downtrend, just to recover this point in the 180 profit booster, This uses a ring high in a downtrend, so bar number 1 and bar number 2 would be the end of a phase 2, moving into a phase 1 to take advantage of the downward market move. The other type of price action that we would look to cover, this specifically is to do with the income wave strategy. Income wave strategy uses high test bars and low test bars. So a low test bar literally equals the fact that price is very likely to move up. However, they are not guarantees that the market is going to go in the opposite direction. So on the left hand side here you can see where the price opened with the toggle on the left hand side. The price opened, the market had more downward pressure. The price was rejected by the market, so the market rejected the downward push and pushed the price up to almost pretty much where it opened and slightly lower than where it opened, which is why the bar is red. You can see here that the red and the green bar look pretty similar. The color is actually irrelevant, but the open and the close must be in the top half of the bar, and this is the strongest type of low test bar, and at least one of the open or close needs to be in the top third. The very fact that the right hand side bar is green just means that the market closed slightly higher than where it opened. So if you imagine throwing a tennis ball against the floor, the downward pressure is rejected by the floor and sprung up the other way. So income wave will use low test bars and high test bars. So a low test bar is in the context assuming an uptrend. You would look for the low test bar to be at the end of a phase 2, bouncing into a phase 1, and you would place your entry above and your stop loss just below. Here are some examples. A high test bar, therefore, means the same thing. It means that price is very likely to move down. The color is actually irrelevant, but again the criteria is the same but in reverse. The open and the close must be in the bottom half of the bar, and at least one of the open or close needs to be in the bottom third. So these are depicting a rejection of an upward push by the market. The left-hand side bar is red because the price closed ever so slightly lower than where the price opened originally, and on the right-hand side the price closed ever so slightly higher than where it opened originally. So if you imagine throwing a tennis ball against the ceiling would reject the ball and force it into downward pressure. That's exactly what's happened here with the high test bar. So a high test bar in the context assuming a downtrend using the income wave is you would look for the high test bar to be at the end of a phase 2, moving down into a phase 1. Here are some examples. Forex in the news. Economic news releases cause major moves in the Forex market. Smart charts will tell you, for example, when a major news release is expected and to be aware that a sudden movement could be about to occur, and it does this in 3 ways. However, as a trader, you should always be looking to understand from an economic point of view when major news items are about to come out. And you could do this with a variety of services. One in particular, you could go to a website called forexfactory.com and take advantage of their news calendar so that you can plan ahead of time to understand which currency pairs may or may not be affected by heavy news items. The trading strategies you are learning can be traded through news. However, those of you that are risk averse or those of you that are more scared of risk may want to avoid the smaller time frames through those high impact news releases. The major news releases each month are non-farm payroll, which is the US job figures. That's generally on the first Friday of every month, and the FOMC meeting minutes, which is the US interest rate changes. News is shown on the chart in Smart Charts by a vertical red dotted line, and hovering your cursor over it will give you the details of the news. And also there is a trading insight window within the system that can show you upcoming news items, and that is shown at the bottom right hand side of the trading insight area. However, as I mentioned before, there are a variety of different ways that you can trade the market and a variety of trading software. What you need to do is always make sure that you use a good online service which will be able to give you an economic calendar so that you can pre-plan ahead of time which currency pairs may or may not be affected. Risk management. Risk management is a key element in any trader's toolbox in order for them to safely approach the market, or as safely as possible. Risk management applies specifically to trade sizing calculation, and can also, in the grander scheme of things, apply to portfolio management. But let's look at trade sizing calculation in order for you to make sure that you are not risking too much per trade. The equation that you need to apply is 2% of your account. So for example, if it was a $10,000 account, 2% would be $200. If it's a $2,000 account, then 2% would be $40, and vice versa. So it's always 2% of your account divided by the pips at risk. If you remember, with looking at the ring high or ring low formations, we had an entry above bar number 2 and a stop loss below number 2. The size of the stop loss, or therefore your pips at risk, would be determined by the number of pips between the entry and the stop loss. So for ease of maths, let's look at the equation and imagine that we had 50 pips at risk. So the size of the bar plus and minus a little bit, i.e. the gap between the entry and the stop loss, would be 50 pips. So manually, the formula at the beginning of this section is, if you had a $10,000 account and you had 2% of that, that would be $200 per trade. $200 divided by pips at risk is the equation. So in this case, 200 pips divided by $200 divided by 50 pips would give you $4 per pip. So in terms of risk, you would be risking $200, and each one of those pips, in this case there's 50 of them, would be worth $4 per pip. From a portfolio management perspective, you really want to have no more, and this is purely a suggestion as described to you before, no more than 7 open trades at the same time, 3 open trades per currency pair, and 14 pending orders at the same time. So use the following formula to stay safe. 7 is the number of minus the number of open trades times 2 equals the number of pending orders you can place. So 7 open trades at the same time minus 3 open trades times that by 2 equals the number of pending orders that you can place. Here is some homework for you to have to do. Make sure you have your own live trading account open and funded. Start live trading as soon as possible. If you don't start live trading in the next 2 weeks, there's more than a 95% chance that you'll never trade. Book 2 coaching sessions for 2 to 3 weeks time, and write down questions for the coaching sessions. Failing that, make notes, and please make sure that you take advantage of the team. We're incredibly excited to see you, to guide you along the journey to becoming a full-time trader and to becoming fully financially free.